Hi, welcome to Forex In Four. I'm Mike Conlon for FXEDU, and in the next 4 minutes, I'm going to show you the highlights of where the action is in today's Forex market. So let's get started.
Good morning. Today is Thursday, May 12th, 2011. This morning I'm talking about sell in May and, well, the old Wall Street adage, sell in May, go away, looks like it may be in play. I'm sorry, folks. I just had to do it. The rhymes were just too easy. But seriously, this morning, looking at the markets here, and you can pretty much see everything's down across the board, with the exception of U.S. dollar and also with Japanese yen. Basically, we've got risk aversion going on. We've got the flight to safety play happening. Okay, there's a lot of different dynamics that are going on in the market, but basically we're seeing global stock markets lower, commodities much lower, and then also the corresponding currencies with those commodities down as well. So we have some fundamental data. There's a lot to get through today, so I'm going to just try and piece it down region by region and sort of thing by thing. But if you think about the overall sell in May concept, the idea was, this is back in the day, where it came from is that all these rich Wall Street guys would go out to their summer homes in the Hamptons. Nobody would get any business done, so you could just sell in May, go away for the summer, come back in September, and everything would be fine. Well, we know we now live in a global economy where that really isn't possible. But what we have this year that's sort of acting as that, I don't want to call it a deterrent, but that facilitator is the end of quantitative easing 2, QE2, that Bernanke had, which is ending in June. So a lot of people were concerned about what was going to happen to the market once all this excess liquidity went away, all right, and it looks like that may start to be having an effect. Now, of course, there's a lot of other things going on that are putting pressure on markets, and this is just one contributing factor, but the one that you don't hear about as much. But essentially, we had commodities spiking, so you have nations around the globe are concerned about inflation, so they're in rate-raising mode. I believe the ECB said they were going to raise rates, but now with commodity prices that are coming down, it's possible that they're not going to do that going forward. So we're going to come back to the ECB and the Eurozone in a second, but so that's the first thing first reason commodities are lower. Second, we've got weakening economic data, all right, not just here but abroad. China, all right, China's trying to slow down their economy. They're making increasing bank reserve requirements. All right, to try and get some of the hot money out of Chinese economy to slow inflation. All right, third thing, we've got the CME, Chicago Mercantile Exchange, who houses all of these commodities. Right, they are raising their margin requirements, which means that it now makes it more expensive for folks to buy and sell these things. So that reduces some of the speculation in the market. As you can see, oil prices are lower. We're down to about $95. We've got gold prices lower. We're about just above $14.80. All right, silver is selling off. And a lot of other commodities are coming down as well. And overall, this is a good thing. Okay, this is a great thing for the economy. Problem is it's taking stocks down with it. Now, should stocks be lower from these levels? I'm not certain. I'm not really a stock analyst, but you can see that there was a lot of speculative hot money in there, and I'm going to go back to the thesis that this is really was a response to QE2, and all these other things are nice, but it was the QE2 problem which really drove these prices higher. All right, so that brings us to the next thing, fundamental data. So what's going on with the fundamentals? Well, let's see. First things first is, before we talk about fundamentals, let's talk about risk. All right, we've got risk in the marketplace, and it's coming from the Eurozone. That's the first thing. All right, so let's just take a quick peek at the Euro. Okay, we can see yesterday I identified that 142 level of support. We can see that we broke down through that. All right, so there's potential here. We're sitting up, just got to about 141.25. All right, we may see a bounce back to 142, and if we get there, that may start acting as resistance. All right, we know about the Greek debt crisis. We know that there's no resolution. Every day that goes on, and especially as we get towards the end of the week, I mean, people aren't going to want to sit long euros over the weekend, not knowing what's going on with Greece. So it's kind of like, we can play the speculative game Monday, Tuesday, Wednesday, but once Thursday comes around, and Friday especially, all right, no one's going to want to be long euro if we don't hear anything from the ECB and the Eurozone as far as resolutions. So that's the first thing going on with the Eurozone. All right, second thing going on with the Eurozone is that the CPI data is abated a little bit, and it wasn't so bad, but industrial production was down. So we're seeing that there's going to be some potential problems with production, manufacturing, that kind of thing, and that's natural as the economy slows. So that's what's going on with the Eurozone. I just want to show you the pound. Pound selling off as well. Okay, you can see yesterday we've got this nice, looks like a pretty orderly move here, just on the 30-minute chart. But pound, we're now sitting up just above 162.50. We're waiting for the GDP estimate to come out. That hasn't been reported yet. If it has, I haven't seen it. But they've also come out with industrial production and their manufacturing production figures, and those are lower than expected as well. So same deal with the Eurozone. All right, we got pound selling off because of these lower industrial production figures. So that's going to hurt GDP. As I mentioned the other day, I believe we're going to see lower expectations for GDP. All right, and that's really the catalyst for the Bank of England not doing anything about interest rates, even though they're saying, hey, inflation could get up to 5%. Although, when we take a look around at what's going on now with commodities selling off and things like that, if that continues in that trend, then inflation may not be the problem that the B of E just mentioned, and they may have just actually called the top yesterday for us. So that's what's happening over there. Just want to show you the Aussie real quick. Okay, Aussie dollar sold off yesterday. 107 was really that area of resistance. They had an employment report overnight, came in worse than expected. They lost 22,000 jobs. The expectation was for a gain of 17,000, and the unemployment rate stayed steady at 4.9%, which is still pretty good, but just shows you that the economy there could be slowing. All right, and it just ties in with the whole commodity currency theme and things of that nature. Anybody else we need to look at here real quick? Dollar yen, you can just see yen back under the 81 level. Your dollar back under 81 level versus yen here. And actually, that looks like a pretty nice reversal candle here. So it's going to be interesting to see what happens here in the U.S. session. Okay, we've got stock futures down in the U.S. Stocks are down across the board. Commodities are lower, particularly oil and gold, silver. Okay, and we've got the markets open. So we've got some clear risk aversion going on, dollar strength, yen strength. Okay, and it looks like the market may want to bounce this a little bit and see what's going to happen. Now we had corporate earnings in the U.S. are going on. I think Cisco came in with a bad number yesterday, so it just sort of shows you, well, things aren't as rosy as everybody thinks they may be, and that perhaps we're going to see a situation where we're going to start to see some declines now. So there's a lot of converging forces going on in the marketplace, whether it's weakening economic fundamentals, whether it's the end of QE2, whether it's the risk in the Eurozone, whether it's lower commodity prices, but eventually we're going to get to a point where lower commodity prices are going to be good for stocks. All right, and that potentially that correlation can decouple. That correlation's been running as an anti-dollar correlation for a very long time. And there's potential that could decouple. We could see a scenario where dollars rising as our U.S. stocks. So that's kind of what we're looking at today. A lot happening. We've got U.S. retail sales figures coming out a little bit later this morning, and we'll see if that increases anybody's thoughts on what's going on. They're expecting sales to go higher, but with the recent high gasoline prices we've been seeing, that may have actually had a negative effect on retail sales. So today starting out ugly, potential to get a little bit better if good retail sales come in better than expected. They come in worse than expected, then this could be a lookout below situation. So, market's going to be volatile today, that's for sure. And that's what I've got for today, folks. So, good trading to all.
As always, be sure to check out the written blog at www.fxedu.com to get complete coverage of today's Forex market. If you would like to learn more about how to trade the Forex market from professionals like myself, be sure to check out our affordable Forex trading courses. And if you're already a seasoned professional or aspire to be one, ask us how we can help you achieve your Forex goals. Go to www.fxedu.com to get started today.